Dharmesh Kant as well, head equity research at Chola Securities, joining us this morning. Dharmesh, what do you do in a market like this? Do you start to nibble on? Do you start to take these dips as opportunities? Do you sell on rise? Because currently, at least technical seem to indicate it's a sell on rise market. What are you doing?
Yeah, good morning, Harsh. Thanks for having me for the show.
Very good
And good
morning.
morning to all our viewers. Yeah, definitely it's a very difficult market to, negotiate with from the trading perspective, and it's anybody's guess how this market will swing. Because one tweet, one statement here and there by Mr. Trump, who is the lead factor in this geopolitical situation, can decide the ton of markets anyways. As far as valuations are concerned, I think market are now fairly priced in. So I will give you three scenarios which we have been working with, and we recently released a report on that. So 1230.40 is what has been our EPS estimate for FY26, assuming there is zero growth for FY27, which is again around 1230.40. So even if you discount that at 17 times or 18 times P multiple 1 year forward, so 21,500 to 22,500 is the zone where it should be fairly balanced, assuming that this war gets over in next 3 to 6 months time frame. Worst case scenario, which we have built in for the Nifty, is valuing same number on 16 times. So that is anywhere around 19,680. So 19,500 to 20,000 levels. So 10% more from here. Stocks may correct 20-25%. So to advise to investors is get into quality stocks. Do a staggered manner of buying approach. I mean, defense is a clear play which is very much insulated from all this impact. Automobiles may be impacted a little bit, but again, the numbers of Q4 were very strong. So there also nibbling can help. Metal is another space where one can help nibbling. But yes, for trading, it's very difficult. I mean, Kunal is the better guy to, recommend that. But from investing, we have been started recommending our clients to put some money at this juncture. Very difficult to decide where the market will go. But my sense is if next week this continues, then we are in for sharper downside movement on Nifty, maybe 7 to 8% immediately.
Dharmesh, we saw some buying interest coming into the IT companies yesterday. How do you look at that sector as a whole now?
Yeah, good morning, Sajid. I mean, the IT is more of a trading bounce and a flight to safety kind of approach. And normally, I mean, people are expecting that this time the commentary from IT companies may be a bit aggressive and indicating some, because Accenture guidance, when they revise the lower end of the guidance, that gave hope to the place. Currency depreciation is the other tailwind which is helping out there. And most of the IT companies have utilized the cash in the balance sheet to acquire some AI companies and have done some collaboration with AI companies out there. So some, I mean, light on that front, and that can, if that leads to an area where our growth can be in higher of mid-single digit, at least in the near term, it can be 6-7%, then definitely there's a good value buy at current levels for most of the IT companies. But we as a house, we are totally staying away from them, and our sense is that it will be more of filling the gaps which will be created by existing orders not getting renewed, which they are, I know the software is not getting renewed, which they are providing as a service as of now, and it will be replaced by AI-enabled softwares, which will be margin dilutive. So how this settles is very difficult to call it now from an investment perspective. But trading play maybe 5-7% can be seen. But if you look at for last 15 days, prices are not moved. It has just oscillated in a range. And on a bad day, they are up half percent to 1%, which gives the hope.
Also, we've seen good updates coming in from some of the defense companies, at least the PSU defense companies. How do you look at them? BEL, HAL, BDL, GRSC?
Yeah, I mean, defense is a tricky place. They are loaded with a huge order book, and we have been fairly bullish on them for last 2-3 years. However, last 1 year, the price action has been largely negative of most of the companies, barring BEL, which was the only outlier in the space. But structurally, we think this is a very nice space to be in, which is, I mean, fully insulated from whatever is going on in the geopolitical space or in the outside world. And the order books keep on swelling. I mean, most of these companies are sitting at 4 to 5 times book-to-bill ratio. But smaller companies are very small. If you look at their top line, they are not even 1,000 crore kind of a top line, barring the top 2, 3, BEL, HAL, and maybe, BDL. Otherwise, most of them are having a top line of more than 1,000 crores. So that's the point which is the worrisome. But I think if you are looking for a cash cow kind of a company, BEL is fairly placed because it services, it supplies components and equipment which are used on a month-to-month basis. So their execution will keep on happening. HAL, it's a fighter plane, light combat helicopter manufacturers. This may take some time, and some of the shipbuilding companies like Majgaon Dock and all. So if somebody is willing to wait for 3-4 years and put in money and be patient about it, then I think the valuations have corrected quite a bit, and these are very attractive and juicier zone to deploy your investment money. And the top three picks, I would reiterate, it remains BEL, HL, and Majgaon Dock.
Okay, Kunal, how do you?
The GIFT Nifty currently at 22,400 thereabouts, and it seems like we're headed in for a 330-point fall when we open up a 4 trade. But again, these are just the implied open adjusting for itself for the GIFT Nifty moves right now. But that said, yeah, Asia hasn't seen any recovery, so to speak. In fact, if nothing, we're down a good 1% now for Hong Kong. 0.5% of a tumble coming in for Shanghai as well. And Japan has slid over 1,000 points as we speak. So it's only worsened from when Trump's address actually got over. Japan is staring now at a solid 2% decline. I want to see what the pre-market rates for the US futures are. A 71-point fall coming in for the S&P futures, over a 300-point fall for NASDAQ, and the Dow futures as well are down 1%, which is about an over 400-point fall even as we speak right now. Oil prices, they continue to hold up, $104 right now, in excess of that actually. So that's the kind of market setup that we are looking at right now as we begin to open up for trade. And this is a truncated week for us as well, remember, tomorrow being a trading holiday. But Dharmesh, curious to know, how is it that you're approaching the weakest link in the market right now, banks and financials at large, and whether after the recent bout of hammering, there are opportunities to buy into or at least nibble into?
Good morning, Aisha. No, I don't think one should be nibbling into banks and financials as of now. We have been neutral to bearish off late for last 20-30 days post this Iran war, commenced. The reason is Q4 numbers, advances and deposit growth number we have seen for most of them on the smaller side. They have been, good or decent, but at the same time, these numbers should not be looked into from more from Q4 perspective, because Q1 FY27 would be more decided. What would be more interesting to see how the provisioning they do while reporting their numbers in Q4 in light of the anticipation of a pain in MSME and retail segment. So 30% of the business is derived from MSME on the economy front, and that is where the major pain lies. So we think that there would be more, pain and NPA provisioning coming in. Some of it would be, preloaded in Q4 itself, and the next round will come in Q1. So a couple of quarters would be difficult for them. Cost of funds have gone up already. This tight liquidity scenario, and going forward, since there is no scene of interest rate coming down, will be difficult for them. In case moratorium kind of a scenario prevails for MSME by the government, which is, this is just a rumor and doing the rounds. In case that happens, that again would be negative for banks, because their cost of funds will firm up further, because they won't be receiving payments from them. The income won't be recognized at the same time. Though the NPA won't be there, but since incomes are not there and the liquidity is tight, their borrowing cost will go up. So NBFCs are the one which is most vulnerable, followed by private sector banks, and the lastly would be your public sector banks. So we are right now staying away from them.
And Dharmesh, some of the smaller banks, they've declared very good numbers. Is that kind of trend standing out for you, and do you believe that the large banks can follow suit?
Yeah, Harsh, the scene has totally changed. Same numbers, if this conflict was not there, that is what we all were expecting. It would have been a great set of numbers for the market to make new highs, and the banks itself. The valuations would have been re-rated to further around 20-30% on a forward basis. But right now, this is historical numbers. This was already expected, which they have delivered around 15-16% kind of an advances growth at large. But Q1 onwards, things are not difficult because already the disbursements and I mean last 15-20 days, whatever when talks we are having, there's a lid out there. But it's not happening that fast. And going forward, if the situation continues, then definitely there will be a loss of business. That is one point. Maybe from 13-14% it may come down to 10-11%. But more interesting would be the part how much provisioning. And one aspect which we all are missing is the bond yields have gone up, fairly large, and that will have an MTM impact on the held for trading portfolio. So treasuries losses would be far higher this time around. 30% of the banking profit comes through treasury operations. So that's one segment which will hit. So net profitability will be impacted largely, some in Q1 and some in Q4. So that's the reason why I said, despite a good set of Q4 numbers, we are staying away from financials as of now.
Point taken, Dharmesh. Just very quick follow-up on that. You've tweaked your Q4 estimates to factor that in, or you haven't because it's too hard to estimate? I'm trying to get a sense as to whether we can expect estimates to start to build in that treasury loss or not.
Oh, Harsh, we haven't, tweaked that because it's only when they tell the numbers we will be able to determine the treasury part of it because they don't disclose how much held for trading portfolios are there. And secondly, what kind of an activity they are doing on treasuries as of now. But hit will be there, that is for sure.
Interesting. Dharmesh, curious to know how is it that you're maneuvering within autos? At least that's where the good news is. Looking at the March numbers, M&M Tatas are clearly surging when it comes to PVs, EV sales, and especially for Tata Motors, it's seen a jump up of a good 77% now. So I guess that's the big turnaround story. Mahindra tractor numbers are looking spectacular. It's only exports for both M&M and Escorts which have seen a little bit of a dip.
Yeah, definitely. I mean, the numbers were rock solid kind of a numbers which came through, and this is in continuation of last 4-5 months. The continuity has been there post the GST cuts which came into play. Whatever input prices have gone up, most of them have taken a price hike. So I think that gets also mitigated on the margin front. No problem out there. And if monsoons favor us this year around, then this run rate of 17 to 20% kind of a volume growth is likely to continue going forward as well. So the overall, the entire space looks very interesting and positive, and after the recent correction, it becomes very attractive as well. Our topics out there has been M&M on the four-wheeler and the farm equipment space, followed by Hero MotoCorp on the two-wheeler space, and Maruti again on the passenger car vehicle space. Tata Motors we are avoiding, though the numbers have been excellent, but Tata Motors seems to have some problem all the other time and again. So that's the reason why, though the price has corrected quite a bit, valuations are attractive, but we are leaving it aside. But these three definitely looks a very good play to get into.
Interesting. Kunal, are you getting any
value retailers? Because they've also come out with numbers. The numbers look strong at the outset. How do you read into it?
I mean, the numbers were definitely good, but value retailers or DMart and V2 retail and all. The only problem is the valuation is far too expensive. They are still trading at much higher PE multiples, and they at best they can do 12 to 15% kind of a growth on overall basis with same sales growth and the new store sales growth both put together. And margins are still either high single digit or low teens. So that's a space which we avoid. Purposely. Because we don't think. See, I can give you a case of DMart. 2021, the price which they made, they are still 20% below that price for 5 years has gone by. So that is the story. On declines, there would be a trading place, but nothing structurally. I think from as a wealth creator kind of perspective, you're holding it for 2-3 years. So we totally avoid that space.
Okay, makes sense. But Dharmesh, great to have you today on the show. Thank you so much for your time.
Thank you so much.
Well, with the FI close now,